Hello, my name is Craig Cole. I'm here to talk about options. The first YouTube video I did, believe it or not, was over an hour long. I had to split it up into 5 different parts. So what I'm doing here is making new intros for those separated videos. I tried to split it up so each part stood on its own. Hopefully, if you view part 3, you don't have to view part 1 and 2 to understand what I'm talking about. Writing options has been around for a long time, and big brokerage houses and banks are the ones writing the options, aka selling options. The average person, retail investor, is the one buying them. We are the suckers. The option market is incredibly large and has experienced significant growth, according to Chicago Board of Trade. In 2022, U.S. option volume reached 10.32 billion contracts, and that included options on stocks, non-equity instruments, and futures. The market is also growing due to increased retail investor participation. Retail investor is you and I, the average individual, and most of us buy options. How would you like to be a part of something that has a daily sales of $32 million? As a retail investor and purchaser of options, you are at a disadvantage. Time is against you. When you purchase or buy an option on a stock or an ETF, the price must move in a certain direction and a certain amount of time to profit. Your biggest disadvantage is time. It eats away at the value of the option. Owning an option in itself does not impart ownership of that stock, nor does it entitle the holder to dividend payments. How would you like to change that to your advantage? You're probably asking yourself, how do you do that? Sell options on your portfolio. That way, the time decay is on your side. There are 2 different terms that are used in selling options. One is sell, the other is writing. Both terms are correct and are used interchangeably. You may hear myself use both terms. When you sell options, the premium money goes directly into your account. Facts about the options market. The option market has substantially grown since year 2000. Trading volume has increased significantly, with estimates suggesting a 15-fold increase since 2000. This growth is attributed to factors like increased retail participation, commission-free trading, and introduction of new options products. Currently in our portfolio, we have sold and closed $15,000 worth of options. That's cash in our pocket. From January 2023 to January of 2024, we did $3,870 worth of options. From January 2024 to 12/31 of 2024, we did $36,000 worth of options. Current total from January 2023 to April of 2025, we did over $63,000 worth of options. That's cash in our pocket. All this may seem intimidating, but once you learn it, it's actually pretty easy. Let us show you how. Remember, this is just for learning purposes, and these are not recommendations to buy or sell anything. Always consult a professional financial advisor. Premiums on stock options start to decay rapidly 6 months before expiration. The maximum amount of premium you can receive is 2-year out options. They're called leaps. And currently that is the longest I've seen an option being able to be sold or bought is 2 years. If you're going to buy a stock, why not write a put option? If you're going to sell a stock, why not write a call option? In this way you can sit and wait to get your price and get paid for it. Not a lot of people know about selling options or that you can even do this. From what I've read, it is usually the professional trader that sells options. Well, I'm here to tell you anybody can do it. How would you like to be a part of a $32 million a day market where the product you're selling is guaranteed to sell? ETFs, or exchange traded funds, are a group of stocks that are traded as one share of stock. They're similar to mutual funds but are traded on a daily basis in the open market. Unlike mutual funds, which are settled at the end of the trading day, if you wanted to sell a mutual fund, the price that you thought you were going to get may not be what you end up with or what you expected. It could be more, it could be less. There is where the advantages in ETFs are. ETFs can be bought and sold immediately in the open market. Now our system is based on ETFs. There is always a down market or sector in the markets. Those are the markets we want to focus on using ETFs in the options. We want to lower our risk of the stock being taken or even being put to us, assigned. The way we do this is we look at ETFs that were down in certain sectors that are moving off their 52-week lows, usually 10 or 20% off their lows. Our goal is to make money off the premium. The more volatility in the stock or ETF, the higher the premiums are on the options. We want to use time decay to our advantage. 6 months out is when time decay starts to speed up. That will be our target in the beginning, and then push the time out further as the market becomes less volatile. We really don't care if the stock goes up or down in price. All we want is the premium dollars. And we want to make money, 20% on our money on the premium dollars, not the valuation of the ETF or the stock. I hope you like these videos. Please leave a comment at our website, www.coltechinvestments.com. Tell me what you think. I hope it gave you some information you didn't have previously. Thank you.